you observed traders around you, or maybe just think of your own journey into trading, you may see a pattern. Some discover trading through a YouTube video, some through a friend, and some just by watching a stock move on the screen. That's how we take our first trade, and sometimes we even make money. That first win can be great, though I would call it a curse. You will soon know why. Because that win suddenly makes you feel you have cracked an opportunity. An opportunity that seems simple, repeatable, and maybe your road to riches. That's usually how the journey begins, or shall we say, that's how you slip down the hill. But markets, as they say, have a way of teaching lessons. Sometimes slowly, sometimes painfully. From early excitement to confusion to searching for answers, and eventually, for a few who persist long enough, a more realistic understanding of how trading actually works emerges. In this episode, we are going to walk through 5 psychological stages most traders go through. From the early phase of overconfidence to the search for the mythical Holy Grail, and eventually to the stage where trading becomes less about prediction and more about probability, discipline, and survival. Along the way, I'll also connect these stages to ideas from behavioral finance and psychology, because many of the mistakes we as traders make are not unique to markets. They are an outcome of how the human brain works. I'm your host Sandeep Rao, and with that, let's get started. Over many years, I have seen this pattern. Everyone who enters the world of trading goes through a remarkably similar psychological journey. Most traders tend to pass through several stages of learning. These stages are less about technical knowledge of stock markets and more about how our thinking about the market evolves. From naive optimism to realism and eventually to maturity. Like life, market also has a way of humbling people. What starts as excitement soon turns into confusion, losses, searching for answers, and eventually, for those who persist, a more grounded understanding of how markets actually work emerges. Let's dive into each of these stages and see how we evolve. And maybe watching it and knowing these stages would help you skip some of them. Let's start with stage 1. I'll call it the first taste. You can call it the first date if you please. Greed or curiosity is what usually marks the beginning. You might see a stock moving up, you watch a YouTube video about trading, or hear someone talk about quick profits. One way or the other, you take your first trade. At this stage, your knowledge is extremely limited. You only understand that there is a stock name and there is a price next to it, and if that price goes up, you make money. This is also a stage where you actually don't know that you don't know. If the first few trades go well, a psychological trap takes over: extrapolation bias. If something worked once or a few times, the mind assumes it will continue to work indefinitely. This bias is closely related to what psychologists call representativeness heuristic, a concept introduced by Daniel Kahneman and Amos Tversky in their famous 1974 paper, Judgment Under Uncertainty, Heuristics and Biases. In simple terms, when we have very little information, our brains tend to generalize aggressively from small samples. So a few lucky trades quickly become a mental success story. If I can do this today, imagine what happens if I repeat it 100 times. That's how our brain looks at it. Soon the imagination runs wild. Lamborghini, yachts, and financial freedom. Why not? But I must say, this stage can be dangerous. Not just traders, many beginner investors also fall for such stuff. All that they do is drag the Excel sheet columns and plan their retirement. I wish it was that easy. Those who remain trapped at this stage often end up taking large risks or bad decisions based on very limited understanding. When losses happen, and they eventually do, they can be severe. Stage 2, I call it the crash of expectations. The second stage begins when you realize that reality doesn't seem to be matching your expectations. At this point, I am reminded of this psychological phenomena called cognitive dissonance. It was American social psychologist Leon Festinger who came up with it. Cognitive dissonance occurs when reality conflicts with our beliefs. Instead of immediately updating our beliefs, we try to protect the original idea. At this stage, the mind struggles to accept that the original model or thinking may have been flawed. Instead of abandoning the idea, most people try to force it to work. They tweak entries, change time frames, add indicators, or increase trade frequency, all in an attempt to recreate that early success. Nothing works, obviously, and many traders quit at this stage. But then there are a few who begin to ask a more important question. What if the original assumption itself was wrong? Accepting that the initial understanding was flawed is often the first real step towards learning. This is also the stage where serious learning begins. People start reading books, researching markets, studying experienced traders, and trying to understand the mechanics of trading more deeply. Unfortunately, this stage is also filled with noise. There are social media gurus, misleading content, and many promises of quick riches. Stage 2, in essence, is the moment where a trader begins to realize, I don't understand this game yet, and I need to learn properly. With that, we move to the stage 3. I'll call it searching for the Holy Grail. At this stage, usually the level of thinking improves some bit, but not enough. The trader now believes that success must come from discovering the perfect system. Maybe there is a secret indicator, maybe there is some specific strategy, maybe a guru somewhere knows the exact method. And with that begins the search for the Holy Grail. This phase reminds me of what social psychologists call authority bias. I think it was Stanley Milgram, the controversial American social psychologist, who popularized the term. Do read about Milgram experiments if such rabbit holes interest you. What authority bias says is we as individuals are more influenced by the opinions of this authority figure, the so-called expert, believing their views are more credible and hence tend not to be too critical of them. And that's one reason many traders move from one guru to another, from one indicator to another. Each new approach promises consistency and clarity. But the fact is, results remain inconsistent. If you are lucky, you might have a few occasional profitable phases, but they are rarely stable enough to build confidence. Eventually, disappointment sets in again. Many traders leave the markets at this point, feeling cheated or misled. They sometimes conclude that trading is either a scam or something that only insiders can succeed at. But those who continue start realizing a deeper truth. The fact that there is no Holy Grail. And with that, we move to stage 4. Let's call it understanding the big picture. If someone survives this far, things begin to change. The focus slowly shifts from finding the perfect strategy towards understanding the structure of the markets. You begin to see how different pieces fit together. Market regimes, trends versus mean reversion, different asset classes, what leverage means, how position sizing matters, what is risk management, how strategy diversification helps, and most importantly, you start understanding the role of having sufficient capital. Trading is not simply about predicting direction of different instruments. It's equally about managing risk, capital, and uncertainty. This stage usually won't arrive as a dramatic aha moment. Instead, it develops gradually over years as experience accumulates and patterns begin to make sense. You also begin meeting others who have a realistic understanding of markets. People who talk about drawdowns, risk limits, and probabilities instead of guaranteed profits. At this stage, a trader can finally make a very important decision. Is trading something I really want to pursue seriously, or should I just walk away? Last and the final stage, stage 5. Let's call it maturity. Here, trading becomes less about excitement and more about discipline. Position sizing becomes central. Strategies are diversified. Risk management becomes a non-negotiable. You also begin to understand something many beginners overlook, which is the fact that for most people, investing is more important than trading. Trading should perhaps happen only on a small portion of the invested capital. Another realization often emerges at this stage is because trading returns are inherently volatile, earning a stable living purely from trading is extremely difficult for most people. Expectations become more realistic. Returns are evaluated with respect to risk, capital, and time. And paradoxically, this is also a phase where consistency finally begins to appear. In summary, the journey through trading is less about discovering a perfect strategy and more about improving one's thinking. Most people enter markets with unrealistic expectations. Many leave disappointed, but those who persist long enough eventually realize that trading is not a shortcut to wealth. It is a probabilistic game that demands discipline, patience, and loads of humility. The markets do not reward excitement or intelligence alone. They reward those who learn to manage risk, adapt to uncertainty, and accept that success comes not from predicting the future but from surviving it. And that brings us to the end of this episode on the 5 stages of trader evolution. Now, it's quite possible that you are somewhere in the early stages right now, and that's completely fine. Everyone starts there. What matters is staying honest about where you are and putting in the work to move up the chain. The sooner you do that, the fewer expensive mistakes you'll make, and you would have way better odds of surviving long enough to actually grow. Before I close, I have 2 recommendations for you. One for those of you who like to read, and one for those of you who like to watch. For the readers, I have this blog post by Morgan Housel titled Low Expectations. The title itself should explain, but do read it. It has some interesting story about Elon Musk and Munger. And for those of us who are into watching Hindi web series, do take a look at this series called Fir Se Ud Chala by Prateek and his team at 01. The storyline of this series is quite relatable. The links are in the show notes. So that's it for this topic. If you find this episode useful, consider subscribing to the channel. It really helps. Thank you for watching, and I'll be back soon with the next one.